Hi, I'm Giri Prakash from TheFederal, and in today's episode of Big Money, we'll take up three investment options, namely Public Provident Fund, sovereign gold bonds, and gold itself, the yellow metal, and find out which of the three is a better option for any of us. But first of all, let me tell you that each of these options have their own advantages and disadvantages, and you have to be very careful in picking up which one suits you better. Now, let us go to PPF or Public Provident Fund. Now, the best thing about a Public Provident Fund is that they have fixed returns and have the government backing. It's like getting the sovereign government backing. PPF is a government-backed investment that offers a fixed annual interest rate. And this rate has fluctuated from, say, around 8.1% a decade ago to around 7.1% as of now. But it's a predetermined price, predetermined interest rate. And therefore, it provides stability and security to investors. You actually know that if you invest a certain amount of money, you're going to get this kind of a return. However, let us look at sovereign gold bonds. And obviously, these are issued by the Reserve Bank of India on behalf of the government and have an initial interest rate of 2.5%. This rate is, by the way, tax-free if you hold the bonds until maturity. Gold, the yellow metal, while it has appreciated historically, it has also seen a lot of highs and lows, and therefore it is subject to, as you say, market fluctuations, making it less predictable than a PPF and an SGB. A decade ago, gold was sold at a price of 16,650, and we are talking of taking the base year as January 1st, 2010, for a 10 grams of gold in Mumbai. It has now actually gone up far beyond around 40,000 rupees. So gold historically has appreciated, and we all know that we all tend to believe that gold is something that we should invest in on a regular basis. However, what needs to be pointed out is that it is subject to market fluctuations. It is not, or rather it is less predictable than a PPF and an SGP. All right. Now, let us look at what the price of gold was in 2010. For a 10-gram gold, it was around 16,650 rupees. Today, the gold rate is around 59,136 rupees. So you might assume that actually it has done well during the last 13 years. But we should also remember that there was a period of time when gold gave negative returns of minus 25% in 2011 and minus 5% in 2015. Having said that, now let us compare the gold prices with, say, Sensex. So if an investor had made a lump sum investment of around 1 lakh in Sensex stocks, the returns would now amount to around 2,30,918. And if you were to do the same thing, and I'm talking of a decade, I'm comparing like to like, and if the investor had invested 1 lakh rupees in gold on January 1, 2010, and on January 1, 2020, his total returns would be around 2,40,000. So please remember, it's more or less the same. Now let's deep dive down further and then find out how does this PPF all play out, right? Public Provident Fund. Now, PPF has a minimum investment duration of 15 years, and the first withdrawal is allowed only after 5 years. You can extend it in sets of 5 years indefinitely, and therefore it is suitable for a long-term saving. The sovereign gold bonds comes with a fixed tenure of 8 years and with an option to exit after the 5th year. And therefore, this may not be as liquid as other investments. Gold investments, as you know, have flexible tenures. You can buy and sell physical gold at your convenience, but this may involve losses due to market volatility, right? Now let us come to tax benefit for each of these investment options. PPF investments are tax exempt up to an annual limit of 1.5 lakh rupees, including the principal amount, interest and maturity amount. Okay, this is big. SGP, which is sovereign gold bonds, they offer tax exemption on interest earned if held until maturity, which is what 8 years it is. Gains from, say, gold investments, including physical gold, are taxed at a rate of 20% along with surcharges. Additionally, there are GST and making charges which apply to physical gold. Now, let us look at the other category, which is safety and security. PPF is backed by the Government of India, ensuring a risk-free return, all right, which falls under exempt status, making the entire investment interest and maturity amount tax-free. SGBs are government-backed, enhancing their credibility. Gold, while it is always considered as a safe haven, is, as we told you earlier, is subject to price fluctuations. Now, let us look at liquidity and flexibility. PPF has limited liquidity, especially during the first 5 years, due to withdrawal restrictions that we have already mentioned about it. SGPs may actually lack liquidity as they have a fixed lock-in period. Gold investments have no liquidity at all. They offer more liquidity than the other two options that that we discussed earlier. You can buy and sell whenever you want. Now we come to the most important one, or the key one, about the historical performance. Now, PPF provides stable, however lower rates of return. SGP offers fixed and market-linked returns due to the gold price component. Gold has always appreciated, except for a few years, but it is always, even though it's not an attractive option, we should look at what we are going to do with it, whether we are going to buy gold and keep it, or are we in the habit of using gold to buy anything that we want. It could be about, for example, using it to generate funds for buying a home, or for interiors, or buying a car. It all depends on whether you really want to go ahead and sell your gold for all these kind of purposes, or for educational purposes as well. Now, we should also look at the fact that there are several factors when it comes to gold prices. It could include inflation, supply and demand, currency value, government reserves, and local market trends. They all impact gold prices. And now we need to look at the future outlook for gold prices. Now, the point here is that we already know that each of the other instruments, which is PPF and GTP, they are actually a fixed tenure, and we know what happens. But when it comes to the future outlook of gold prices, we need to understand it has seen significant fluctuations in recent years due to economic uncertainty, and also because of COVID-19 pandemic. The future of gold prices depends on various factors, including geopolitical events, economic conditions, and currency movements. So we have spread out all the choices, all the do's and don'ts, and all the factors relating to these three investment options. And therefore, choosing between PPF, SGBs, and gold investments depends entirely on your financial goals. And yes, your willingness to actually sell gold for any definite purpose. That has to be kept in mind. Usually what happens is any household which buys gold tends to retain it for a long period of time. And they would rather take a loan to buy a home, for interiors, or for educational purposes, rather than go ahead and sell the gold. Now, ultimately, the better option depends on your individual circumstances and investment objectives. It is always advisable that you diversify your portfolio to balance risk and returns effectively. Obviously, you need to consult a financial advisor who can help you make informed decisions which are tailored to your specific needs.
Subscribe to the Federal's YouTube page for more news and updates.